let's rock and roll. So good evening again, October 11, 2021, in our Alfonso's VIP workshops. The topic for today, guys, it's a very interesting one. We're gonna learn how to build in and out vertical debit spreads. This is a different type of a strategy what we usually do intraday, because involve buying and selling put contracts or call contracts at the same time in order to mitigate some risks. And also the idea here is this is a very good strategy and product or vehicle to grow a small account with some relative low risk. Of course, the returns are not the ones that you used to see during day trading. I mean, 2, 3, 4, 5, 10 baggers, but it's very consistent. Strategy is very, as well as I say, low risk. It does not depends a lot that you're right on the direction that you take. It's more important how do you build the spread more than your bias, if it's right or wrong. So you can be right and wrong or both. You can be profitable or you can be unprofitable on this strategy. So the important thing is how to build it. So without more to say, let's start with this. I did this small presentation for you to follow up, very easy. And let's see. So can you see you can see the joker, but you cannot see the main screen. Okay, let's see. Share, let's see, PowerPoint. Can you see that now, the presentation? Nope. Really? No? No presentation? Okay, so let's share. So that was the reason why I was not able to see. Now you can. Here, not gone. Okay. But I wanted to share this part. We can see the joker with the sticker in other spreads. Yes, that is the presentation. Can you see it now? Okay. So this is the presentation. Can you see the next slide here? Let's go our spreads up. Okay. So that is the presentation. In and out vertical debit spreads. Let's start building our vertical spreads. We're going to consider the fine risk vertical spreads when we want to take directional bias on an underline. So what does mean? If you really want to take a direction, and Saumei Lau, please, you mute your mic. I muted for you. Is this serious? And I cannot.
Sorry.
This is out of this world. Okay. So we're going to consider define a vertical spread when we want to be biased, right? Okay. I think that this underline or this index is gonna go that or this way. Is when we take an in and out spread. Why? Because it's a low risk product that can define your risk, limit your risk, limit also your maximum profit. But if you want to take directional bias is the most appropriate one. More and more when you want to take a directional bias in a swing type product, right? Like this one. And it's very simple. If you're bullish, you just, or bearish, the in and out spread will provide you with a strong risk reward without exposing the famous time decay, right? And plus the volatility, but plus a risk of being stopped out. So the advantages of the in and out spread is that you don't have practically, you do have some decay, but there is very little. You don't have, which is theta. You don't have vega exposure as well, which is the volatility. And you don't have to put any stop loss for this, because since it's a limited, or is a defined risk, is already included in the structure of the in and out spread. And if you have any questions on the road, just let me know. So what is this, the spread structure? We build a vertical spread with a risk 1 to make 1 scenario. So remember our risk reward ratio for day trade, so it's 1 to 3, right? So since they are more risky, way more risky, you need a better risk reward ratio, because you are very probable to have very low rate of being right. In this case, since we're taking an edge here in the way that it's a high probability trade, the risk is 1 to 1. And yet we can do trades offering high probability. However, when we want to be directional bias, we want strong rewards with the least amount of risk. So you see, if you really want to be right in your bias, you have to take the highest probability to make that happen. And of course, that as more secure or more probable, less amount of less risk and less profit, right? In and out spread will provide the equilibrium that we seek in our trading. We can have we can be day traders, or they have very aggressive bias, and we have a defined goal for a daily goal or daily loss. And on the side, we can also work on this type of low risk scenarios to build a small alternative, small account that you have on your side that will bring you some, or either some extra income or extra sources for trading your daily strategies, right? Or your intraday strategies. So what is low risk and what is so important? Because what we're doing is we're offsetting the Greek's risk, right? In this case, and probably now you can see and tell me if you can see my pen. Can you see my pen? Here? Not the pen, okay. So I have to figure that out. But anyway, but you can see, nope. Okay, probably should be a way to do it. I don't want to mess up. But anyway, if you follow me here, I'll figure that out later. But I have here an example of option chain where we are buying and it's called in-out spread because one leg is in the money and the other one is out of the money. So in this case, we're buying a 59 call and we're selling a 61. So what does that mean is that we are buying 8 Vega, 8 cents of Vega. So for each percentage that the volatility increases, in this case, we gain 1. For each percentage, we gain 8 cents. And in the theta, it's minus 0.2. That says that for each day or determined on time that each day you're losing 2 cents. This is for the naked call, right? When you sell that call, what you're getting is the contrary. You are getting negative vega and positive theta, and you offset at the end of the day 8 minus 8 minus 2 plus 2. They offset each other. So with an in and out spread, your vega and theta are 0, so they have no effect. So if you see, you can take a in and out spread 20 days to expiration, 30 days to expiration, 40 days to expiration. And if you take the same strikes, the cost of the spread is going to be the same. What is the difference? The difference is going to be how quick that probability is going to get to you regarding of the time that you're taking, right? So that is the reason that if for the same strikes, you don't have a different price for the spreads on different time frames. So in this case, we buy the 59 calls and sell the 61. Therefore, we buy theta and vega in the 59 calls and sell theta and vega in the 61 calls. The in and out vertical spreads on a strike in the money and one strike out of the money offsets the risk. And that is the reason why you get rid of the part of the Greeks risks that you face with a naked put or call. Are we clear on this? Any questions so far? Are you following? No, yes, no questions, and you're following. Okay, so that is clear, right? We're buying a naked and we're selling a naked call or put at the same time to make a vertical debit spread. What is debit? Because you're gonna pay for premium. The result of buying and selling these calls or puts are gonna be a debit. So you're not selling premium here, you're buying premium. So next slide, let me get rid of this. So let's do not overthink the direction, right? Directional bias can sometimes torment traders. Am I going to be right? Am I going to be wrong? What is the hourly, the daily, the weekly? So don't overthink your bias. I mean, you are not on tweet away from total chaos, and something can happen anyway. You can be very bullish today and tomorrow Powell decides to start tapering and everything goes to hell. So you don't have to worry too much about your bias. So let's think about many of trades that we have. Just think of how many trades you have done in the past and being 80% sure of the bias, and something came up and nothing happens, right? So how many times you've been directional accurate? I mean, pretty sure that not 80, 90%. Or maybe you bail out on a trade that are only to watch later to go in your direction, and the day after or minutes after you sell it, right? So the in and out spread, what they help is that they keep you on a trade longer, because since you already have a limited risk and you already have a defined probability of achieving that profit that you're looking for, it takes all the emotions away and you just let it work, right? You just very easy. You just set your stops. There's no stop. You just set your limit orders and you just let it work. And what you do is just, of course, you don't forget about it, but you just let it work. So that is very stress-free trade, right? So in and out vertical spreads, entry criteria, guys. So let's get it deep into, if you already more or less understand why they are called in and out spreads, why they are vertical, right? Because you buy one strike and you sell another one vertically up or down, regarding if it's a call or put. And debit, because you pay for them, right? You don't sell them, you buy them. You are long a put or a call debit spread. So going to the criteria, and this is very important. What do we have to look for the type of underlines for this type of in and out trades, debit spreads? The underline has to be massively liquid. Liquidity is essential. Why? Because you see the spreads on when you're buying a naked call or put, how can determine the success of your trade. For a debit spread is even more important, because you're buying and selling at the same time two instruments, right? So the spreads have to be friendly, and the only way to find friendly spreads is with very liquid products. And very liquid products means tight bid and offer spreads and high open interest. So you need one thing brings the other one, but you have to make sure that you have both high open interest and very tight bid offer spreads. Weekly options availability in the product that you intend to trade is also very important. And most of the underlines that have weekly options are very liquid. And that is the reason that they have weeklies, right? Not all the underlines have weeklies. Some of them only have them. SPYs don't even have weeklies. They have 3 times a week expiration. And some other pros, not many, but some others. But at least you need products that have weeklies. In these times, sometimes the word weeklies sounds riskier, right? When I say weeklies, it's not because you're gonna take the weekly or the 0 to expire expiration. What you're saying is that the underline has to have weekly options, and that means that if it has weekly option, it's a very liquid product. Liquidity is variable, but generally you want to be the smallest fish in the largest pool in order to achieve viable trade execution and pricing. So where you're looking to be here is low profile. And you want to be the smallest fish in a very large pool. Why? Because when you want to bail out of the spread, even because you're profitable or because you have to bail out break even or with a small loss, you want to do it quick, right? And you want to make sure that that when you execute that trade, you can close it. So where to start? We're gonna start, and we already started. And you have seen one of the Captain One Lots, and you will see what I call them Captain One Lots trades. We're gonna start doing ETFs. And then, of course, we can expand our horizons to any other products. At the beginning, we're going to stick with underlying offering weekly options. So liquidity is going to be our friend. We need massively liquid markets, stock or indices with products where you don't have questions of liquidity. SPX, SPY, Apple, Netflix, Amazon, Facebook, Tesla, Google, NVIDIA, blah, blah, blah. You already know who they are. Products do fall in our in and out of our favor over time. Reevaluate how liquid is my product. So we have also making sure that that product continues to be liquid in order for us to continue trading, right? The step 2, the directional bias. If we're going to buy a call spread, we're going to buy a call spread if we're bullish, and we're going to buy a put spread if we are bearish. As simple as that. We don't do more things. Calls if you're bullish, puts if you're bearish. Since we're not selling, we don't have to do the opposite, right? We are buying premium. So today's class focuses more in the logic and the criteria of how to execute this trade rather than an individual trade or chart setup. Here is more important. If you find the right criteria on the option chain, regardless of what is happening outside and what you think about the underlying, if you make your trade taking in consideration all these important criteria, that is more important than what you think about what the underlying is going to do. And we shall also disclose a few setups and offer nearly a dozen of courses in the future of how to be directional bias. Of course, this is one of a series of workshops that I'm going to be providing. I mean, in this case, it's only debit spreads. We're going to have butterflies. We're going to have earnings. We're going to have credit spreads, selling premium in naked calls or puts sometimes. And we're going to be moving forward in that direction, but we have to start with the basics, right? And see, most of us have small accounts. We have to start having this type of good tools and strategies that can help us build our portfolios in a less risk manner. So directional bias, step number 3, time horizon of the in and out spread. Using an in and out spread, we offset our time exposure, the theta risks, as I explained earlier, why we offset it. So the time that we're going to take is not really related with the theta. It's going to be related with other type of aspect that we have to take in consideration. Since we having offset the theta risk, we are enabled to select a variety of expiration cycles without being impacted by the decay. What we're going to do is we're going to look to buy debit spreads with a minimum of 9 days remaining to expiration, but maximum not to exceed 50 days. What it is going to determine if we see that probably an underline, for example, XLE, the energy sector, has been grinding for the last 2 or 3 weeks, has been going up and up and up. And it's not that we're going to be bearish on it, but we know that uptrend has to have a retracement soon, a small one or medium size. Probably we can take a contrarian bias, like saying, okay, well, I'm going to get some put spreads here, not because I think this is going to be, the XLE is going to be now bearish, but I'm just looking for a retracement, a very normal retracement to, so the XLE continues its bullish trend, right? So in that regards, you are flexible to take up probably. I mean, it's been 4 in a row weeks, so I might take a 9-day, 10-day to expiration debit spread in only 2. Or if I think no, probably I don't know exactly how long it's going to take us, could be okay. So I take 15, 20, 50 days. So, and of course, the days that you're going to choose within this range are going to be based on what you look in the different expiration dates and looking for interest, open interest, and how the skew is doing. When I mean skew is the difference between the short-term and long-term volatility of the different strikes, etc. Right? So the exemption for time shorter trades are viable during earnings announcements and binary trading events. So if we really want to be biased in something, I don't know, tomorrow is going to be the job reports. And I think that we're going to be bearish because of the job reports. That is the only time that you can take less than 9 days, because you already have a binary event taking place in the very near future. And you know that that event is going to create a catalyst that is going to move the price, right? Otherwise, if nothing in the horizon under our knowledge is going to happen, we have to take at least minimum 9 days to 50 days of expiration. So are we good so far? One thumb up, at least. Good. Okay. Step number 3, the right time. Selection of a spread time frame is one of the most important things. You want the underlying above or below, depending on your directional bias, the short strike at or near expiration. The in-out vertical spread will not mature to full value, of course, until closer to expiration. Or if it goes very deep in the money, right? That was the example that we had with this CCXI. It still had 10 or 20 days till expiration, but since it went very deep in the money, it almost reached its maximum price. It's not gonna get 100% of the price, or very unlikely. It can, but it's very unlikely because it has some value from extrinsic value from the time that it has remaining. But if it's very deep in the money, time and everything, it's offset, and that is the only way that you can get 100% of. So because of that, and because we're not looking to take these instruments to expiration, we're not going to look to get 100% of the maximum profit that it can be achieved with this type of instruments. Sometimes we'll get it, sometimes we're not, but we're not looking to get 100% of the total or the maximum profit that you can get, since we're gonna be selling them either with a small loss before expiration, or we're gonna let them die out of the money. Step 4, strike and price selection. The strike price selection, we are buying a debit spread. Strike price we buy is in the money. Not at the money, in the money, right? At least one strike in the money. And the strike price we sell is out of the money. So if we're buying a call, the call that we're buying, it has to be in the money, and the call that we're selling has to be out of the money. If we're buying a put, the put that we're buying has to be in the money, and the one that we're selling has to be up out of the money, right? In the call is going to be down, and in the put is going to be up. And that is what is called in-out spread. One in, one out. Buying an in-the-money option and selling an out-of-the-money option offsets theta and vega risks. So that is the only reason, and that is the only type of spreads that vega and theta are offset 100%, because one is in and out. If we buy a vertical spread that is out of the money, both legs, you are going to offset some theta and vega, but you're not going to offset 100% of it. So that is why this in and out spread becomes very low risk, because you offset 100% of both Greeks. It's the only way to do it is buying an in and out. If you buy it very out of the money, you're not going to get 100% of offset of both Greeks that are theta and vega. So the price is right. Another important thing that we have to be very careful how much we pay for these spreads, because if we don't play the right amount, maximum amount, the probabilities for this trade to be successful and to be profitable are going to be way less than they use. So what is going to determine what is the right price to buy, of course, is the skew. And the skew is the difference between how much is the volatility that you're buying versus the volatility that you're selling. When the skew is favorable is when you buy a call that has less volatility than the call that you're selling. In other words, what you want to do is buy cheap volatility and sell expensive volatility. When the skew is inverse, that the strike that you're buying, the volatility is higher than that you're selling, that is a very stupid decision. So you have to take care. So what is going to define us if we're doing a good purchase of a spread is going to be the price that results of the spread. In other words, if we're buying a $2 wide spread, 20 call, 22 call, that's $2 wide. The maximum that you can win or you can sell that spread in the future is $2 because it's $2 wide. It has to pay no more than $1.05. So this, guys, is like you have to write it down somewhere and make sure that every time that you buy an in and out spread, if you buy an in and out spread that is $2 wide, you cannot pay more than $1.05. $2.50, $1.30. $5, $2.60. $10, $5.20. That's a golden rule. Do not pay more than above for each unique wide spread. As simple as that. You don't have to understand the Greeks and the skew and all that complicated shit. Very simple. $2 wide, 105. I don't pay more. No more. I don't pay more by. I pay less than that. Hey, it's 85 cents. Perfect. It's 60 cents. A bargain. It's 106. I don't buy. Right? I don't buy. I put a limit order and I wait. If it doesn't fill, it's not a good trade, period. Or we're late or we're chasing or whatever. So are we good on this? This is one of the most important parts of this Captain One Lots, guys. At the end of the presentation, I have like a cheat sheet with everything is going to be in one slide. Everything that we discussed and all the criteria is summarized. So don't break your head too much. So can I continue? Are we good? Good. Step 5, position sizing and allocation. So here is the second most important thing after you already found your right price and everything. What is the size and allocation? What I mean sizing is how many contracts, and what I mean allocation, how many contracts of each and how many do I allocate on that day, right? On that level where the spikes or Qs are at that moment. So size the trade accordingly to your money that you're willing to risk, of course, like always. Accept the trade will have a little or no salvage value and a loss will be near 100% of the risk in the trade. In other words, it's like a lotto. If you can, with much better odds, but it's like a lotto that you're willing, you're gonna buy the amount of contracts that are gonna give you peace of mind if they go to zero, right? Trades only defend trades when they are taking large losses. Traders only defend trades when they are taking large losses. We will enter the trade with a defined risk and comfortable capital risk. comfortable position size allows us to sustain the trend, what we shall hence for the term duration over direction, right? So the good thing about this one is that since it brings you peace of mind. For example, if I place today, if I would have placed a debit spread on BABA and my spread was a put and BABA went ballistic to the moon, since I have time, I just need a good retracement during the next, I don't know, if I took it 20 days out, in the next 20 days, just to be, or at least break even and get out, or even get profitable. So the duration is going to be more important than the direction, because at the end of the day, we don't want that trade to expire when we wanted to. We just wanted that trade to touch that level within the term that we bought it. And once it touches, we are golden. That doesn't matter if it touches only for 15 minutes, 1 day, or for 3 days, right? So account allocation guidelines. Define dollars at risk per trade. You must define the per trade dollar at risk. Remember, we have done this many times. For example, you want to allocate 2% of a 10K account on per trade basis. That means if you have a $10 account, all your spreads are going to be $200. When you are constructing each trade, it's imperative that you keep dollars at risk in each trade consistent. In other words, if I call the first captain lot spread, and that captain lot spread is $2.50, one contract, one spread, and then I call another one, SPICE, if the spread is $1.25, even though it's called captain one lot, what I mean is that the lots have to be the same size. So if the first one was $250, it's only one contract, the second one has to be 2 contracts, so can get even. In other words, all the trades within this portfolio have to be the same amount. And that is what is captain one lot, because it's going to be only one lot, but that doesn't mean that it's only one contract, right? So if you're going to define, okay, my lot for the captain one lot trades are going to be $500. You better have the sufficient capital to distribute $500 on each call or play that we do. And this, guys, is very important. I urge you to adjust your amount per trade on this in order for you to can give you the ability to play them all. This is very important. You have to take them all in this. In this case, we're going to be shooting between 1 to 3, no more than 3 or 4 trades of this type every day. It's going to be very rare, because the idea is to, once that the market start to move in different levels, you shoot 3 at 4,000, you shoot other 2 or 3 at 4,100. You can, if we stay on 4,000 on the SPICE, I'm not going to shoot more, right? Because you're going to be allocating all the spreads on the same levels. So you just have to distribute like seeds when you're walking on the road, right? A little bit here, a little bit there, a little bit there. But adjust your amount per trade to something that can at least give you the opportunity to have a portfolio of, I don't know, 10 trades, 5 trades. You define that. So they can give you at least the opportunity to play them as much as, if not all, most of them, right? So that is very important. Do your absolute best to keep the dollars at risk in each unique trade consistent. No trade should ever stand out. That is very important. If you don't do that, this strategy is not going to be successful. So we're clear on that, right? Very important. Less size, more trades. When allocators always think less size and more trades, this is what I just explained you. Don't go heavy on any of them. Go same size and determine that size in a way that can give you the ability to have more trades. That is imperative. That is music to our ears, right? Because we're going to be trading all the time. So for the first time, you're hearing over trade in certain way, right? So use less allocation per spread and do another spread. What I mean with this is sometimes people say, hey, I mean, you're taking a $2 spread, take a $4 or $6. No, instead of taking a 4, take 2 contracts of 2. That has more probability that to take a $4 spread. You have to take 2 contracts of, I'd rather take 2 contracts of a $2 spread than 1 contract of $4 spread. So that is very important. So why trade big in any one spread when we can scatter smaller trades over a large number of products? Variance will keep you alive in heavy volatility, right? We're gonna be diversified in somehow, but we're gonna have different type of sectors, different type of bias, right? We're gonna have a variety of sectors playing, and we're gonna have a variety of bias. We're gonna have puts and calls, and we're gonna have health, financials, energy, technology. So we're gonna be diversified. And right now that we're having a lot of rotation, but today technology up and financial scenario down. Tomorrow, financial scenario. So this is perfect because this type of strategy is gonna help us out to at the end of the day, hit right all of the trades, because at some point, one or all of those trades are going to be doing good performance because of the rotation that we're seeing among the different sectors, right? At least in these types. So in summary, guys, more on allocation of capital and placing multiple trades later. Okay, in the course, we're going to see how we can allocate this. Now, we already know what to buy, when to buy, how much to buy. And the next step is when we get out, right? What is going to be our exit criteria? So we have different scenarios. We're going to exit profitable if the underlying trades in your intended direction. So you're going to close the spread if or when probability reaches 55 to 65% of the initial risk. For example, if you buy in a spread for $1 debit, if or when the spread reaches a value of 155 to 165 or above, close the spread immediately. A debit spread is closed via selling the spread. There was a question, hey, but I have one leg positive and the other negative. Yes, you're always going to have that because you're buying and selling. And the difference is what makes the spread, right? So a spread, the maximum that a spread can be sold, again, is the spread. If it's $1, it's only $1. If it's $2 spread, $2 is going to be the maximum price, $3 and so on. So that is what very important that we respect those levels or maximum prices to pay for the different spread sizes, right? Option number 2, we exit on a middle ground. What does the middle ground means? That we're not profitable, but we're not 100% losers on the trade, right? The trade's approaching and it's having 4 days or less until expiration, preferably no more than 4. So the merry-go-round is when the spread is coming to a closer expiration and not hit the profit target. So maybe we can be 10%, 15%, 20, or 10 minus 10, minus 20, minus 40. So then it comes a decision that, and it has 4 days till expiration. So what are we gonna do? Are we gonna win it or lose it or draw it, right? So at that time, we're gonna determine, no, I'm gonna leave it and see if I can get the profit that I want, or I can bail out and take a small loss, or I just get out right now, break even. But we don't let it, unless you wanna leave it to close out of the money and worthless, that's the only reason that you don't do anything. But you're not gonna sell it 1 day or 20 minutes before expiration. Or either you sell it 4 days prior, or you let it die until the end, or get rewarded, okay? And very important, if your spread is in the money, you have to close them no matter what, because you're gonna get assigned, right? Very important. Are we good to continue? One thumb up, please. Yes, good, good. This is what I know that I'm not talking. Exit criteria number 3. So we already see profitable. We already saw so. Now we have a third option that is rolling. Rolling is moving the spreads from one expiration into a longer duration expiration. In this case, guys, in the spreads, we're not moving the spread in strikes. We're just moving the spread in time. If we have a spread that is almost break even, has 4 days till expiration, I can move it a little bit, 1, 2, 3 more weeks out, probably reduce the strike, but it has to make sense, right? Or it has to be for a very small debit or even a credit, right? So rolling, moving the spread on expiration to a longer duration expiration. Rolling an in and out spread should only be done if the trade is profitable or at break even. If it's red, no. If it's profitable but hasn't reached our 50-65%, we can roll it in order for us to buy some time and get that maximum or that target of profit that we're looking for. We do not roll losing in and out spreads, as this only increases our risk with a losing position. I have explained that. Rolling is a trade procedure where we sell our current in and out vertical spread, the spread that we bought, and simultaneously we buy another in and out spread in a future dated expiration. Rolling the in and out verticals is typical using the same strike vertical as I explained earlier in a future expiration. So we don't gonna move the strike. We're just gonna buy more time. And we're not looking here to make money on the roll. When we are rolling on intraday basis is to take some risk off and to take some profits. In this case, the only reason to roll on the spreads, on the in and out spreads, is to buy some more time in order for us to achieve the target that we're looking for. So therefore, the rolling can be done for a minimal credit or debit, but minimal is defined as no more than 10 to 15 cents in any product. So the maximum that debit that you're gonna pay for a roll shouldn't be more than 15 cents. Optimal between 10 and 15. And that is very important as well to take in consideration. And then the last criteria for a loser, the end spread can be left on into expiration if completely out of the money and will expire worthless, which is what I recommend. If there is even the slightest chance the long leg of the spread may be in the money on expiration, you must close the trade. You don't have to have 2 legs in the money. Actually, when you have two legs, you have less risk. But if one of the legs gets in the money, on expiration, you're gonna get a sign on that one. So that is why the reason you have to either sell it 4 days prior or you let it die if you are very far out of the money, and it's very unlikely that in the next 4 days you're gonna get even close, right? So long positions in the money by 1 penny or more on expiration will be out of executed, making you long the stock and susceptible to large losses. So that's what you have to sell. Optional closing criteria. This is optional. I don't recommend this, but this is one way to do it for those who want to have even less risk. The following probability of touching when losing is an optional closing variation. You can take a full loss on an in and out spread, or you can select to close the spread when the probability of touching the long leg in the spreads falls below 45%. In TOS, on the option chain, you have volume, open interest, delta, theta. You have also a label that says probability of touching. The probability of touching is 2 times the delta of that underline. What that means, that is the probability that that underline has, or that contract has, to at least touch that level prior expiration. So if that probability goes below 45, I don't use it and I don't recommend it, because the problem, if you start doing that, now you have to follow that criteria with every single one of the other options that you take. Otherwise, you're gonna reduce your odds for success. So mine is there. You can take a look at it. You can consider it. I don't recommend it, but I just wanted to give you that there is a chance to have a type of a stop loss if you don't wanna incur in risking 100% of the trade. At the end of the day, why I don't recommend it, because you're gonna see that if you allocate and follow all these criteria, you're gonna have a very high percentage of profitability of profitable trades. So there's no need, but there is, just in case. So in summary, guys, that it's been what, 1 hour? Yeah, it was not that bad. In summary, I just did here a summary of what we just saw. So in and out spreadsheet criteria, cheat sheet, liquidity, massively liquid ETF, index, and equities, directional bias, buy a call if you're bullish, buy a put if you're bearish, expiration selection, minimum 9, maximum 50 days, strike price selection. Strike price, we buy in the money strike and we sell out of the money. When buying at $2, no more than 105, 250, no more than 130, 5, 260, 10, 520. Position size and allocation, less size, more trades, capability of taking 100% loss, and execution of the spread, send the order at mid price of the mid bid ask, and set your limit order to 50 to 65% limit sell strike. I mean, limit order to sell profitable, good to cancel. So you don't have to, so you just leave it there, good to cancel. If it hits that, you're gonna get alerted and you just move on with the next trade that we're gonna be playing. So that's it, guys. So now you understand what is the name of Captain One Lot. And now you understand that one lot doesn't mean one contract only. It's only a half the same size of lot. Anybody and everyone is going to have a different size according to their risk tolerance and account size. But just that you have to determine that by your own. And if you have any questions, you know where to find me. So hopefully this was of interest for you, and we're going to be playing more and more plays of this kind, so we can have a diversification of other type of plays. And this is perfectly for the ones who don't have the opportunity to be all the time on stream, or they have a full-time job or a lot of stuff. So, or you can do both. I mean, it's a good way to diversify. And it's always good to understand why and what is the right criteria to take certain. At the end of the day, this criteria, what it give you is give you the bet odds to get an edge. And if you have an edge, if you do it this many times, you're gonna be profitable. You're not gonna be gambling. So if there's any questions, if not, we wrap it out and we can see you tomorrow, but I'll take questions if you have some. Anyone? All good, Daniel, okay? Okay, guys, if there's no questions, it reaches 30. Okay, yeah, that's very important, guys, that I didn't include here. If a trade gets between 30 and 35% in day one is the day that you bought it, plus 3 days, trading days, not business and not regular days, 3 trading days. What is the best advice that I can give you is sell it. 30, 35 within 3 days, sell it. It's better to later take another trade and use that money to take another one. So don't wait. If it's an in and out spread, if for some reason we're playing out of the money and that's out of the money spreads, that's a different story. But in and out spreads, this one that I explained today, 30 to 35% trade plus 3 days out. Okay. Thank you for reminding me that. Yeah, I didn't include this in the slides, but yes, it's very, very important. It's just a good way to take profits. That doesn't mean that trade is not gonna get 55, 65%, but I mean, you already got 35 in less than 3 days. That I know that 35 for us intraday traders is nothing. Oh, I can take that in 5 minutes. Yes, but because of the risk and the complexity of this trade and what we're looking at 1-to-1 risk reward ratio, 35% is more than they done. So yes, that is very important. I will include one more slide with that. Anything else? Thank you for reminding me that. Very important. Thank you. Sell it. Cody has one, I guess. Okay. Anything else, guys? Nope. If not, we wrap it up. See you tomorrow. If you like what you saw today, spread the word. And it's going to be in circle if you want to go back and see the criteria and everything. And that's it. If you don't have any other questions, have a great night. See you later. Adios.